All right, so let's get going. Welcome everyone. This is our webinar number 330. That's it, Saturday, 31st of October, the last day of last calendar day of October month 2020. With there's 2 more months to go in this year. Hopefully 2020 goes out. The sooner it goes out, happier I am. Just waiting to welcome a new year. This has been a very eventful year, to say the least. So we'll be happy to let it go. So in today's session, I'm gonna talk about a lot of earnings. This week was full of earnings. If you like earnings, you want to stay active in market, this week was like a kid in a candy store, especially if you are more interested in the tech as I am. We had earnings coming up from all the big tech companies. Almost 30% market cap of SPY reported earnings this week. So we're going to dig a little deeper into the earnings from big names. We're also going to review some of the portfolio protection strategies using options. There are many. So we're going to review in terms of over a long period of time, what works, what may not work. And of course, we'll do our regular market summary, what caught my eye. Then we will also look at some of the option trades that we have been carrying along week over week. As always, if you have any question, put it in the chat, and I will be monitoring chat as we go along, and we'll respond to those questions. All right, with this, let's get into it. Usual disclaimer, this is not an investment, financial, or any type of tax advice. We are here to learn from each other. Consider it as a piece of education. Use it the way you deem fit. Talk to your advisor if you need further more information on how to use this for your portfolio. Just don't blindly go and trade based on what you see or what you hear in today's session. All right, I want to start with a quote today. And Steve already mentioned brutal, that this week was brutal. And I already had this quote, and believe me, Steve and I, we didn't collaborate for this one. So like I had mentioned before we formally started on today's session, is I was a little low on trading this week just because there's too much of a volatility that is expected in the market. And I just want to wait and watch and play accordingly. So I utilize my time in reading, doing some reading. So the book I started reading is it's called The Book of Joy. This is a collection of discussion between Dalai Lama and Desmond Tutu. And I've done, probably read half of the book. The quote that caught my eye was, "Pain is inevitable, suffering is optional." And I'm sure we all can relate it in our personal lives in terms of when something happens. If it happens, it happens. We can't control it. There are factors which are outside our control. But how we react to it, how we suffer is in our hands. So, but that's okay. I mean, the book was all about that, but that also got me thinking how we use this all concept also in our investment philosophy, especially if, I started using this a lot more when I started trading options. Is market goes down, it is inevitable. If I'm in market is volatile, I can't change it. I wish I had that crystal ball of predicting where the market will go, but no one has it. If anyone claims to tell you that they think where the market will grow, maybe you should run in another direction. But what happens to our portfolio and what happens to me as a person is entirely up to me. So whether I'm suffering from those market changes or it's nothing burger, that's entirely up to me. So that portion is definitely optional. When I started trading options, first thing I learned was we have to take what market gives and stop complaining about market did this to me. Market did that to me. Those people in Wall Street, those computers and algos in Wall Street are killing common people. What I started focusing on is given what market will do, which is outside of my control, how do I make sure that my portfolio is ready to withstand anything that market gives? That's why we are market takers. We are not market makers. We take what market gives and then we decide, how to fortify our portfolio to make sure that we don't suffer if we don't want to. That is optional. So with what we saw in this week, in some cases, I'm sure some portfolios have definitely gone down. Some portfolio could have gone up. Market is the same for everyone. How each portfolio suffered is an optional to that particular investor. So I think very apt quote. I was just reading that book. I thought I'll share. This is an investing session, and I could find some link through my life on, linking this particular quote to the investing life. So I thought I'll share that with you. So that's a quote for this week. Let's get going. I do see some comments. Ramesh says, market goes up, market goes down, prepare for more. I'm writing option for next year and closing what I can profit. So far, covered calls are profitable and have closed few already, buying few stocks at a time. Cool. That's good, Ramesh. I am little lesser active. I'm not writing too many options right now, but that again depends on situation to situation. We'll talk about it when we'll discuss portfolio protection strategies. Optional as in options. Oh, that's good. Yeah, I didn't realize that one, but now if I see it is optional, yeah, that does give that linkage. Shannon says the quote fits perfectly with a healthy stock market mindset. So I don't know, Shannon, did you mean healthy stock market or healthy mindset towards the stock market? Both are two different things in my perspective. Healthy mindset is, I don't care where the stock market goes. I will be there to meet the market wherever it is. And healthy stock market is obviously market goes up. So I don't know what exactly you meant when you said, okay, healthy mindset. Yes. And it comes from practice, at least what I've seen is, I wasn't like that. It took a lot of practice to stop complaining about market. And you realize that, I can complain all the time, but that's not going to change anything on what's happening in the market. So now stop complaining. I see if, portfolio has done bad. Why? Now we have the tools to protect it. The question is why I did not choose to make use of those tools. So it's up to me. Or those fingers are no longer pointing towards those Wall Street guys. It's pointing towards me is why I did not make use of the tools. All right, so let's do a quick market wrap up. No surprises here. Everything is red except volatility. That's again one tool. When market goes down, the traditional hedges of bonds and the gold isn't working anymore. Most of the big market indices, SPY, Dow Jones, QQQ, which is tech, they all fell close to 5%. Even the small businesses, IWM, it's down 5.1%. The traditional hedge of gold and bonds weren't any better. I mean, they didn't go high. The bonds, TLT, 20-year plus bonds is down 1%, and the gold was down 1.5%. But VIX was up 22%. So when, let's say, market goes down, there are things in the market that also goes up. And if our portfolio is set up to take advantage of those, maybe some of the people would have been smiling even in this week, or those who are having short deltas in their portfolio. So yeah, and I think for year to date, I do have a year to date chart. So let me make sure you can look that. That's not an eye testing for you. From a year to date perspective, still QQQ, Gold, and TLT are the top three performers. SPY is now almost on a break even from year to date perspective. I think it's up only 0.5%. And Dow Jones Industrial Average as well as Russell 2000 both are negative for the year. This is in stark contrast to the last week where SPY was up almost 4%. Things have changed this week. And we don't know what's next week is going to bring, except the fact that participants are expecting a lot of volatility, but we don't know whether markets will go down, markets will go up. There have been thoughts and discussions around in both the directions. When initially some of the talking heads were saying if Democratic Party gets a clean sweep, that will be bad for market, and then suddenly the tone started to change, saying if you get the blue wave, it will be good for market because that means more stimulus as we had seen earlier this year moved into the markets. So essentially, I think no one knows. And anyone's guess, and my guess is as good as anyone's, your guess is as good as any other talking heads guess. So, just take it don't take it at a face value. People say this is what's going to happen in market if this party comes into power. We really don't know. S&P sector-wise, almost all sectors were down for the week. No surprises that energy and financials still are at the bottom of the ladder. And tech, communications, and consumer discretionary are the top three performing sectors for this year. A quick look at the other investable assets, which are crypto assets. Today, we're not going to talk about decentralized or crypto world. We already finished the series of 7 sessions in past 7 weeks. So I hope now when I bring about any information from the crypto world, you have that context. We did that context building exercise for 7 weeks. So no more talking about that in terms of the basic concepts. So let's focus on what's happening in that market. And now these prices could have changed because the crypto market is open 24/7. I took the screenshot yesterday night, so things could have changed by then. But as of yesterday night, Bitcoin was up almost 5%. And Ethereum was down 6% and so on and so forth. There's no recommendation to go and buy Bitcoin or Ethereum or anything else. But as we had discussed in our previous sessions, we are seeing a lot of interest being generated in this market from traditional players. So we want to keep an eye on this particular investable asset as well. All right, let's talk about some of the other news that caught my eye. Let me sip some water. All right, the first one, and this has been fun for watching JP Morgan doing its seesaw on whole crypto assets. 2017, 2018, Jamie Dimon and JP Morgan comes says, and all this Bitcoin and all the digital decentralized economy is a fraud, blah, 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 blah. And now, last week, JP Morgan, in their letter to their customers, especially mentioned that Bitcoin value implies that could be compete more intensely with the gold as an alternative currency. From calling it a fraud to calling it as an investable asset for their customers, that's a huge change from JP Morgan side. So let's dig a little deeper into what JP Morgan had to say. Bitcoin's role as a gold competitor, that's why some people call Bitcoin as a digital gold, is amplified by millennials' investor interest in cryptocurrency and the inevitability of younger investor demographic becoming over time a more important component of investor universe. That's a circle of life. The millennials of today will gather more and more wealth as they progress in their life. They will become much bigger segment, having most of the investable wealth available. So I think every investment bank or any financial advisor would be looking towards and seeing what are those millennials interested in. A generation, 2 generations above, before me, my grandpas and grandparents, they were interested in gold, physical bullion. My parents, the generation that was interested in bonds, CDs, stock. My generation is also interested in gold, but not as a physical gold, not as a, in form of jewelry or a gold coin or a gold bar, but an ETFs. A generation that is coming, the next one, millennials, looks like they are more interested in the different kind of asset, not anything to do with the gold. So JP Morgan wants to make sure that they are focusing on what the new generation is interested in, because eventually that becomes a store of value. If more and more people consider that a piece of gold has some value, then the piece of gold has some value. A few hundred years ago, the piece of copper had more value than piece of gold because that was available in less quantity. Gold was available in ample quantity. People paid more, value. People paid more attention and accorded more value to copper. Copper was more valuable. In the next generation, JP Morgan thinks that it could be Bitcoin. So Bitcoin's market cap would have to increase by a factor of 10 before it could match the total private sector investment in gold. So even a modest crowding out of gold as an alternative currency would imply doubling or tripling the Bitcoin price from here. Let's see, beyond millennial investor interest, the note highlights, and this is the, if you want to do some little more reading, this is a note which JP Morgan sends out to their, let me just pull that out. This is a report that's called Flows and Liquidity. It's not available for free. So if any one of you are JP Morgan's client and have gotten this, you probably might have already be aware of. But what I'm referring to here is a summary of that report put out by people on the web. And it also says the significance of corporate and legacy investor interest, giving credibility to Bitcoin as investment vehicle. We saw it in the last 2 weeks. $6 billion worth of Bitcoin is now on corporate balance sheets, serving as a treasury function instead of buying treasuries. $6 billion worth of Bitcoins are now lying on corporate balance sheet, which is almost the number of Bitcoins is 3% of Bitcoin, has already been cornered by public listed companies. And of course, we are all aware of what PayPal did. The authors also identify strong growth in institutional investor interest, indicated by activity in CME futures. We also saw institutional investor interest when companies like MicroStrategy, the hedge fund, missing out the name, that we talked about 2 weeks earlier, they got $115 million of Bitcoin. They bought the Bitcoin worth millions and millions of dollars. Anyway, lastly, even though the Bitcoin is considered currently overbought for the near term, the potential long-term upside is considerable. Again, whether it is overbought, whether it is still underbought, or it is lower than where it should be, who knows? That's anybody's guess. But good to see JP Morgan doing a complete flip-flop from their stand on what this Bitcoin was and now where it has become. Okay, and also JP Morgan came up with their own coin. If not Bitcoin, let's use JPM coin. So JP Morgan had been running a big blockchain project for almost 2 years, even though JP Diamond and all their public facing PR would talk negative about all these coins, but they have been building their own infrastructure, and they created their own blockchain called Quorum, and now they revealed it in 2019. So they have been building it while Jamie Dimon has been beating up Bitcoin on the backside. They've been building their own platform. Now, on that platform, probably they're gonna, their whole idea was to use this for facilitating interbank transactions. Recently, they sold off this particular project, Quorum, to Consensus, which is another company involved in facilitating and promoting blockchain-based projects. But JP Morgan has created a business unit with 100 employees to still continue to work on projects related to this. So good to see a traditional bank taking a big step in this new economy. Let me see some comments. Why not sell puts for the next year for the stocks that have taken a beating? So again, this will be personal to personal, Ramesh, from where my portfolio is. I want to right now have a good amount of a cash, because I don't know where the market could go, say, by end of November. Could I have more opportunity if the market goes down? Maybe that could be the right time. Maybe, I don't know. So that's the reason why I'm not started selling, any long-term puts for next year. I have done a few trades, mostly I think defined risk, or in this week, probably I went a little shopping on some of the stocks that we're going to talk about, in a subsequent session. So we're going to talk about some of those stocks today, which I did shop a little bit, but I'm not yet selling the puts for, let's say, January or February expiration. Other thing that caught my eye, telehealth. It continues to grow. We all have talked, or probably, those who have been attending these sessions for quite some time know about Teladoc. I've talked a lot about Teladoc. Also, their competitor called Amwell. We did a deep dive on Amwell when it went IPO. So a quick updates from Teladoc, they crushed Q3 earnings. The revenue was just under 289 million, which is double than the previous year, same quarter. Net loss, however, was bigger because of all the investment that they had to do around the COVID stuff. But in any case, both the numbers beat analyst expectations. So other quick highlight that I saw from Teladoc was the number of visits. And these are the virtual visits. There was year on year, that growth was 206%. That's amazing. The revenue grew almost double, 109% from the quarter previous year. So this is a huge tailwind. Especially COVID has provided a huge tailwind for all this telehealth sector. And in past few weeks, I had to use services of my doctor and my hospital. And when we called them, their first option was, let's do a teleconference. And if only needed, then we'll call you. And so for my kid, I had to do it. All we did was a few teleconferences with the doctors. So there's a huge growth that we are seeing in this sector, and not just for telehealth for humans. Other thing that caught my eye was Chewy. Now Chewy has started a service called Connect with a Vet. Now that allow the pet parents to connect directly with a licensed vet to get answers to most commonly asked questions. So now, if you own a pet, you also have a choice you don't necessarily have to go to vet's office, but you can, get a quick health checkup, get your questions answered about your pet through a telehealth. So that's an interesting development. As we know, Chewy is a company that sells a lot of supplies for pets online, competing with Amazon, but handsomely beating Amazon in this game. And now they're moving into a telehealth for pet. So interesting. It was initially launched in Florida and Massachusetts in May. So they did a pilot in 2 states for almost 5 months. Now Chewy has expanded it over to 35 states with the plans to offer it to the remaining 15 states. So this is cool. It is free of charge to customers. Again, Chewy's main business is to sell pet supplies. I don't have a pet, so I've not used Chewy's products or Chewy's services, but like many other retailers, they are trying to move on to the subscription-based model in which, as a pet owner, you subscribe to a set of supplies, maybe pet food, which comes to your door, which is being shipped by Chewy, after every 2 weeks. You don't have to go to website and reorder. It just lands in front of your door. And those subscriptions are the most profitable ones. I mean, every company is trying to do that. Amazon, if you go, they'll have those Echo Dots, which will order for you automatically. Anytime I buy a supply on Staples, let's say if I'm buying a printer toner, both Amazon and Staples will tell me, just subscribe to it and we'll give you 10% off, 15% off. It means they'll send me a printer toner, every month. So to get more and more customers to move to a subscription model, Chewy is giving this service free of charge to customers who are subscribed to their auto ship program. I see some questions. Other than T-Dog, which other names in telehealth? The other name which I talked about was Amwell. There are few other names. I have to go back and look into the Amwell deep dive whenever we did. Or Vijay, you can check on the website. I forgot which session was that where we did a deep dive in Amwell. From the public listed companies, I think Amwell and Teladoc. The third one was Livongo, but now Livongo and Teladoc has become one. Teladoc completed the acquisition of Livongo on Friday. So Livongo will not be traded anymore on the website. I think the other one, which is not exactly telehealth, but moving into that space, is Massimo. I think its ticker is MASI, like that. Let me just look at. But the big ones that I am aware of and I have on my radar is the Teladoc. Let me see if there's anything else. Oh yeah, so here is, I actually had a screener called MedTech. So Amwell is there, ISRG, again, that's not a telehealth. Livongo is there, Massimo. Yeah, it is MASI. And then Teladoc. Good RX, not telehealth, but health. So Good RX, I had looked into Good RX. I was not too excited about Good RX, Vijay. Sorry, that question was from Asif. I was not too excited about Good RX. That's why I didn't bring it into this meeting. I didn't find any moat on Good RX. So I did spend some time in looking at Good RX when they went IPO. I know this is a recent IPO. So I'm not interested in Good RX based on what I saw from their S1 filing. But you could have a different opinion. So maybe you want to look at a Good RX, but this is in a Good RX business model is to send prescription to your homes. And given the fact that now there is a lot more pressure on pharma companies to reduce the prices, Good RX will be squeezed a bit more. So I couldn't see anything on the Good RX in terms of what's the moat on their businesses, how will they be protected against. So that didn't entice me well. Okay. All right. Any other questions? All right, let's move on then. Tesla. Tesla fell almost 6% or up to 8%. I don't recall the exact number, but there was it fell a lot. So to say almost 6-7%. So let's see, and why. Now Tesla is going to a price point in which this bear, that is me, could become a bull. I've talked about it in almost every session that looking at the Tesla's price at the current valuation, I am bearish on Tesla, but a bear can become a bull at an appropriate price point. There is a right price for everything. Maybe, if Tesla falls another few percent, it could come to a price point where I could become bull. Especially, I liked what I saw in Tesla's recent results. We chatted about it on the Slack channel as well, saying for the first time, I am converting into bull for Tesla. But that was like a week ago, and I had no idea in terms of what Tesla stock will do. That's a completely different story in terms of what stock does and what a company does. So from the company perspective, I started to like what I saw in the results. But anyway, let's look at what happened to Tesla, and especially around the competitors of Tesla. So GM announced the launch of electric Hummer, and let's say it is sold out in a pre-order phase. Take it with a pinch of salt. I don't have any information on how big was this pre-order, but whatever it is, GM claims that it has been sold out. Consumer Report mentions that GM's Super Cruise autonomous tech is superior to Tesla's, is better than the Tesla's autonomy. Second is Ford. Ford's driver assist as a service. They are adding this hardware into the F-150s and the Mustang's Mach-E electric SUVs. So again, even all the traditional automotive motor companies, they have to survive. They need to move to EV, electric vehicles. That space has been really, really hot. And now companies like GM, Ford, they are not only moving just to EV, but they are also moving on to autonomous vehicle. We all know about Waymo, which is a division of Google. We've heard about what Uber is doing, in the autonomous vehicle space. Ford recently, not recently, but I think some time ago, they bought a company, Argo.ai or Argo.ao, which is, again, work on autonomous vehicle. I think GM had bought Cruise Automation. Again, that was a company focused on building software for autonomous vehicles. So now we are seeing those technologies are being incorporated by traditional vehicle manufacturers. Not only GM and Ford, Fisker, it had its IPO this week. It went IPO through a SPAC route, and on day one, it got 14% pop. I think it happened on Thursday or Friday somewhere. Fisker plan is to start production of Ocean EV by 2022. So there's an interesting story of, I think, Fisker's CEO. He was earlier working in Tesla and then moved out and started company Fisker. So some more competition coming from Fisker in US, and then in China, which is right now the second biggest, but could become the biggest market for Tesla. NIO is pinching at Tesla's heels in China. We talked about NIO multiple times. We also looked at NIO's battery as a service concept, which I think Elon Musk has talked about, but Tesla has not achieved that yet. NIO has already done it in China. So competition is growing. One name which I did not see in the news, but I think that will be a big force to reckon with in coming years, is a Volkswagen. They are also doing a lot of work on EV side. So I should add Volkswagen to this list of competitors. And maybe Volkswagen could be the biggest threat, than GM or Ford. Who knows? But a lot more. So we saw Tesla taking a beating this week. And one factor is also that Tesla's stock was anyway highly, highly overvalued. So now it depends on what you consider Tesla as. If you look at Tesla as an automobile company, then the valuation doesn't make any sense. If you look at Tesla as a tech company, even then the valuation doesn't make sense. So it was anyway richly valued. So that also could be one of a factor, why we saw some cooling off in Tesla shares last week. Still like Tesla, even though it fell before 50 EMA. I think I like Tesla anything under 350, 360. And that was my price point, at which I had mentioned a while ago when we did a trade on Tesla, saying this is a price point at which a bear in Tesla like me could become a bull in Tesla. So I don't think it has reached there yet, but let's look at where Tesla. Yeah, so Tesla is almost 380. It has fallen below their lower Bollinger Band. Let's look at, if we really want to look at the EMAs. Yes, it is below their 50-day EMA. So this is 200 EMA, too low, but I'm still waiting, Anyway, I have a trades on this one. I'm not doing any more trade on Tesla. I already had one, kind of an iron condor. So if it goes below 360, I will be assigned some of the Teslas, and I'll be okay to start owning Tesla at that price point. Hummer deposit was $100 only. I don't know. I didn't dig deeper into what's the deposit was for Hummer. Was it 100? Was it 1,000? I have no information, Ramesh. All right, let's look at some of the other thing. Verizon, they launched a project called Full Transparency. It's a blockchain verification for news releases. We've been talking about blockchain in past 7 sessions on how this technology could change the way that traditionally the businesses have been conducted, and not just the businesses in financial services sector, not just you know it's businesses in currency, but overall a lot of other services businesses. So this week I saw Verizon started using this blockchain to make sure that the news that as a viewer you see is authentic, and you can find out whether it is authentic, whether it has been modified. So they started a project called Full Transparency, which is a blockchain verified record of changes for its news releases. There's a whole big news around it. Basically, what all they are doing is to bring faith of consumers back into the media news that they see online. Looks like they did a survey, and nearly 60% consumers believe that the media they consume is contaminated with untrustworthy information. And I am probably one of them. They didn't reach out to me for a survey. If they would, I would have been in this camp. I stopped believing anything that I see that comes to me in any of the social media platforms. If I see anything on WhatsApp, I don't believe it. Now, I feel for me, the life has come back to full circle that I used to read newspapers, and that's all before social media came in, before those newspapers became extinct and everything moved to online. And then stopped reading newspapers, didn't have any subscription, believed in what I saw on Facebook, what I saw on online websites and on other social media apps. I've given up Facebook, so I don't use Facebook anymore, but I still use some of the other social media apps. Now I come back to the point wherein I don't believe anything on what I see coming across me on, let's say, WhatsApp or on other social media. Now I got subscription of newspapers. I have more faith now, putting more faith on the traditional sources of news, which is like newspapers. So that's my story, and looks like Verizon is building some technology which they can offer to these news media outlets, in which they can confirm that this news piece has not been modified and not been changed in any way. Or when you're looking or reading that news, you will know whether this has been modified from its initial version or not. So an interesting project. Hopefully a lot more corporate houses and will pick up on this one. This could go a long way in combating the fake news or fake media that has plagued our society. Can't trust the traditional news media platform either. They have their own agenda as well. Again, each of the news media, you have to figure out which one you are comfortable with. What I was referring to was when the news comes out, then before it reaches us, somebody has already modified that form of a news. Now, if the initial source itself is reported wrongly, let's say if Associated Press news that we receive from AP itself is wrong, then there is nothing much I can do about it. I can't go to the source of the news or to the place where something has happened to verify personally. But if it has been released by AP and later on, if it has been modified, at least I'll get to see, am I seeing it in the original form it was released, or has it been modified? That's this project about. Do you know if VZ creates its own or use IBM blockchain? No. So they have worked with a company called Mad Network and Ad Ledger. So there is a, I'll paste this link if you're interested. There is a link around this project. Let me put it in the chat. Yeah, you can read more about this project in this link. But it was interesting to see more. And again, what excites me is the application of this technology in our real world, in our day-to-day life. I've been talking about it in the sessions for quite some time, saying the initial application was that cryptocurrency, but this technology has got much bigger impact on our life in the coming decades. So be prepared for it. That's all we want to do. So it was nice to see Verizon, using this technology for this particular project. Next one, digital coins, federal digital coin, right? Exciting one again. Rather than discrediting the whole concept of digital coin, now the federal banks, 7 central banks in the BIS, which is Bureau of International Settlements, they released a report assessing the feasibility of publicly available CBDCs, which is called central bank digital currency or digital coin, essentially in which you will have a digital coin, like you have a Bitcoin, Litecoin, those are called digital currency. In this cases, the digital currency will be managed by the central bank. Means like you and I, individual, could have an account with our Federal Reserve Bank. Today we don't. Today, indirectly, we deal with Federal Reserve Bank through the commercial banks. So between us and the Fed, there sits Bank of America's and Fidelity's and Chase and JP Morgan's, JP Morgan Chase is one, JP Morgan Chase and Wells Fargo's of the world. If this whole project becomes a reality, I don't see why we couldn't have an account with Federal Reserve directly or with Treasury directly. It will be so much easier and remove so much of friction and inefficiencies in the system. The recent one has been the stimulus checks that Treasury wanted to dole out to all the people who have been impacted by coronavirus and were having an income below a certain level. Took weeks, in some cases months, in some cases checks would have ended up on an address where people don't live anymore. And that whole process was so cumbersome because Fed has no way of Treasury has no way of directly dealing with individuals. So they left it onto the banks, and we know what happened. It took weeks for people to get their checks. But if CBDC projects becomes reality, it's directly, there's no need for all those intermediaries. So the report outlines the foundational principles and the core features of CBDC, but it doesn't tell whether you want to do it or not. Most these central banks, and those are the big banks we're talking about: Bank of Canada, Bank of England, Bank of Japan, ECB, US Federal Reserve, Sveriges Riksbank, they probably from some of the Scandinavian country, and Swiss National Bank. These are the banks who came together. I think all the heads on the bank now realize that this is a new wave of digital coins. Either they jump into it or they'll be left behind. Some other currency will take over. Most of them are fearful of Chinese yuan. Chinese yuan, China has already created a digital coin version of yuan. Those who have an account in China or probably have relatives in China can talk more about it because they might have better information. And if anyone have in, please chip in. I am only talking about what I gather from my study. But and recently China did a project. They did a pilot project and issued 10 million I think $10 million worth of yuan or 10 million yuan. I don't know exact number, can't recall. But at a particular localized place, they issued digital currency just to see how people can make use of this. And they got really positive feedback. Now, the latest news I see is Huawei, which is now number 2 smartphone maker in the world behind Samsung. It was number 1, but because of restrictions imposed by US, they are getting a little difficulty in sourcing their supplies, or the tech supplies as well as the software supplies. Now they slipped to number 2 behind Samsung. Huawei has mentioned that in the newer set of phones, those will come preloaded with hardware wallet, with the digital currency wallets preloaded on the phone. So every phone that they will sell, and I think probably this is only applied to China, will have a digital currency wallet already in your phone. So my thinking is all these other banks probably are getting scared that if the whole Chinese digital yuan picks up outside of China, which China is trying to do a lot, with their trading partners, is trying to push towards trading using yuan and not dollar. And that means if dollar loses the reserve currency, then that will be definitely not good for us. So China is already way ahead in this game. The other central banks, the ones which are Federal Reserve and all the allies, they have just started on a project. So the project is about coexistence with cash and other types of money in flexible, innovative payment systems. It's not that the cash will go out, but eventually I think it will go out because cash is so secret. There is no way to track cash. But if it becomes CBDC, which is central bank digital coins, then all the transactions would be tracked. So this whole white paper talks about how a central bank can issue a digital coin, why they should do it, and how that should work. Again, some of the banks have actually started pilot projects on it. Some of the banks are just putting a team together to start pilot projects on these ones. China is way ahead. They already have done their pilot. They are probably looking to ramp up the issuance of digital yuan to their citizens. So that was a really interesting story. I'm going to keep an eye on what's happening on this federal digital coin. To me, I think it's the way I look at it, this is a great testament to the fact that this whole concept of digital coin, irrespective of whoever issues it, right? Whether it's been issued by a Fed, by central bank, or whether it's been issued by not an authority or not by any centralized authority is a different. But the fact that if people become more comfortable in dealing with digital currency, that could be a huge tailwind to other types of currencies as well. If I take a parallel example, which I love to talk about whenever I talk about this particular new world, is go back to internet. Think about what happened in internet, let's say 1980s, 1990s. We had CompuServe, we had Prodigy, and we probably had more. I'm not aware of it. I wasn't in this country at that time. So I don't know, but two names that I heard was AOL, CompuServe, Prodigy, all had their own version of internet, closed internet. People became comfortable with it. People, you know, were intrigued by, I can send a message to someone else sitting thousands of miles away and we can exchange kind of letters. Once they became comfortable, Hotmail came. It's okay, easier. I can jump onto Hotmail. That became more open internet. So AOLs and the CompuServes of the world don't exist anymore. But the taste that those, initial taste that they gave it to users around the usage of internet, that did the right thing for the growth of internet. So I would see these federal digital coins as a version of those islands of internet. You could still continue to deal with it, or if some other currencies gain more acceptability, that could become a future. That's all we have to see, later. We can't predict anything sitting here right now, but it'll be interesting to see where this project goes around. All right, lastly, an early Christmas gift. That's something I came across. As there was some gentleman selling their courses for options, talking about options, trade management, volatility in 2 hours, selling for $140. I'm like, ooh, either you can join this or you could view the recording of the option boot camp that we had done a while ago. We did a series of 12 sessions, each of 2 hours, on talking about all these topics one after another, starting with very basics of option, volatility, all the way to risk management. And it was free. So those you had participated in those option boot camp, you're welcome. Consider that as an early Christmas gift from my side. So, and I'd mentioned earlier that if there is, I see more requests for basic option education, maybe we'll do that a boot camp session again. But for now, we do have the recording available on the website. So if you want to see it, it's over there. Or you can join any of these sessions. $140 per person for 2 hours. Okay, so in this session, we're going to review various portfolio protection strategies. And those strategies are based on options. Now, most of you are already aware because you participated in those boot camp on what some of the basic option strategies are. So now if I talk about things like caller or put or a call, at least I'm hoping that there won't be questions around what's put or what's a call. All right, so we'll review what works and what does not. And this is the study that I read through and I want to share with you. Not mine, but this was a backtesting study and the simulation study done over a long period of time to figure out what essentially works. So again, this is not an investment, financial, or tax advice. Please use this as for your education and try it out before you go, full steam on what you learn from here. So quick background. What I'm going to do here to go through an in-depth study of portfolio protection strategies. There is a document if you want to do on your own. You could study this document. Let me just bring that up. This was a study done in Sweden a couple of years ago. Portfolio protection strategies. This is 116 page long, which talks about, let me just see. First, it talks about what ITM talks about basic options. Then they talk about the Black-Scholes Metron model. That's the model on which all the option premium pricing is determined. They talk about volatility risk. They look at various protection strategies, and then run the testing, run the Monte Carlo simulation to tell exactly what's the results that they are seeing as, after they've run through all these protection strategies, right? So we could go through this if you have time and you have energy, or you can sit through my presentation. If interested, let me put this link out to you. Those who are interested and want to go through this, I will put it. Okay, Ramesh already asked for it. So there we go. Okay. This was a study done at KTH Royal Institute of Technology, School of Engineering Sciences. So it has got some, it was, some decent credibility behind it. It was done for a project in financial mathematics and a degree program in applied and computational mathematics. As a part of a graduate degree program, they did a whole study of what portfolio protection strategies actually work over a longer period of time. The question that we will seek answers to in this presentation is a protective put strategy really an effective way to hedge an equity portfolio? This is a strategy which most of the people, when they get into options, are aware of. Market will go down. Let's buy puts. Let's buy puts, right? As a protection. And many of retail investors actually get their first toe into options, toe dipped into option C with this. They start into options because they want to hedge their equity portfolio, and the first thing they do is to buy a put. I got a shares. Market could go down, so I'm going to go and buy a put. So the biggest, in this study, they looked at, is the protective put really an effective way to hedge? And that could be an eye-opener because most of the retail investors do just this. Are there any other protection strategies that provide relatively better tail protection? So let me just bring that up so I can explain tail protection. By tail risk, so if you really look at how the market behave, over a long period of time, market is a normalized distribution curve. Most of the time, and we have gone through in our boot camp multiple times, is market will tend to stay within one standard deviation, right? But that doesn't mean to say that markets won't go, over here or don't make those big swings. We saw that swing in March, right? So this is called tail of the curve. Now, generally to protect us when, let's say, market goes so far down, which happens once in a while, this is called tail protection. How do I protect, the tails when the market move, make these moves? So are there any tail risk protection strategies? This is what the study intend to find out. So there are multiple strategies for protecting the portfolio, and those have been developed over years. We will discuss what are the advantages and drawbacks of each strategy. Then based on what works for you, you could pick and choose how and which one you want to implement. Okay. The whole intent is that I give you enough information so that you can make an informed decision instead of blindly following someone else who's telling you, hey, I bought puts because I expect market to go down. Maybe that buying put works for him. May not be for you. I don't know. Each one's portfolio is different. Each one's expectations are different. And the whole intent is I want to share what I saw in this study. And then also, I will also pull up some, other studies. And you make a decision based on what works for you. So quick methodology, what they did in this particular project was to run Monte Carlo simulations on SPY. Data SPY is one of the most liquid ticker being traded on US stock exchange market. Monte Carlo is also the simulation that is being used on, let's say, Thinkorswim platform on the back end. When you are looking at your analyzed graphs, those graphs are built using those Monte Carlo simulations. Or there are other simulations also, but Monte Carlo is one of the most used. Then they also did the back test to check with the actual results. They ran the simulations, then they looked at how those simulations, when those gave the results, because now all they're looking at is looking at a history. They also looked at what was the variance and try to reduce, modify their model to reduce the variance as much as possible, so that when they're doing any of the projections or looking at the numbers, it is as close to what had happened in the real world. Essentially, that's what it is. So now let's jump on to some of the protection strategies. Protective put, that's something which we talked about. Protective put spread. Instead of just buying a protective put, in this case, we are buying a protective put spread. Third one is collar. Is a collar strategy. So now go through each one of them. Let's look at a protective put. Means purchasing out of money put as an insurance, a fixed percentage away from at the money. All I mean to say is, if today SPY is at 327, right? That's where it closed on Friday. I'm going to run a simulation that I will buy a put 5% away from the current price. Right? So I'll go down 5%, 327, 5%, let's say around $16. So I'll go down to 311 and I buy a put at 311. So that would be my purchasing an out of money put 5% away from at the money. Okay. Guys, if you have any question or if you don't understand, anything of what I'm going to discuss, please put it in the chat. I am assuming that you all are familiar with put spreads and the collars, and I won't get into the details of those, even though I will show you some of the graphs for those who have not gone through the boot camp and still need some background info. But please put it in the chat if you have any questions. In this case, essentially we pay a premium because we are buying a put, but that premium will cover my portfolio if the stock falls below the strike price. So if S&P SPY falls below 316, I'm covered. Sorry, below 311, I'm covered because I bought a put at 311 strike price. And I still have potential of unlimited profits. And this is what attracts most of our retail investors is. I got an insurance and still have unlimited profits. So I can protect my portfolio without giving up the possibility of unlimited upside. And that is why many of the retail investors, and probably I won't be wrong if many of the financial advisors also advise their clients to make use of puts as a portfolio protection. I know there are some financial advisors in here, so this is not to cast any aspersions or anyone. I'm just sharing what I read. This is generally done for shorter duration, 1 month, 3 months, or 6 months rolling, right? Because this is like our insurance, right? I don't want to run my car legally. I cannot and should not. I don't want to drive my car without having insurance on my car. I could generally people, take insurance in 6 months, but I can work out a plan with my insurance provider and say, I'll pay you 1 month rolling insurance. Every month I'll renew my insurance instead of renewing it 6 months or yearly. In investment world, people buy puts maybe 1 month out. They keep on rolling those puts 3 months out or 6 months out. So this is your protective put profit and loss diagram would look like. In this case, the stock, I bought it as 45. I I bought a long put at a strike of 40, means $5 below where I have a stock cost. I bought a stock at 45. And then I bought a put at 40, which is $5 below, means 9% lower, not 5%. In this example, it is 9% lower. It means my portfolio P&L will be like this. The stock, my losses, I don't care where the stock goes. And this is the only stock in my portfolio. Let's assume that. I don't care where the stock goes. If it goes to 30, 37, my losses are capped here. My portfolio start to lose, but below 40, my losses are covered. So this is what is traditionally our deductible, right? Below that certain deductible, my losses are covered. So my deductible in this case is $5. I bought at 45. Stock could go down to 40, but any losses beyond 40 are covered by the protective put that I bought. But I have to pay a premium to buy this. So I have to pay a premium of $2.04 to get into this insurance. This is what a protective put P&L diagram is. Unlike cars where the value doesn't increase, stock could increase in value. And in this case, if a stock goes to 52, you enjoy the gains in the stock. And that is what is an enticing feature. People jump on to puts is, I don't have to give up on the upside. I still enjoy the full upside while protecting my portfolio beyond or below $40. Okay. The second is bear put spread. In this case, it's a leg apart from a protective put. It creates a spread because as we have seen in the previous one, I had to pay $2.04 as a premium. In this case, I don't want to pay so much premium. I want to pay, little less. But of course, there is no free lunch here. So if you are paying little less, your protection will be less. So this is how your portfolio P&L will look like. Again, I have only one stock in my portfolio, which I bought at 45. And I had bought a put at 40. But then I sold the put at 30. That becomes a put spread. But instead of paying $2.04, now I'm paying $1.55. My initial outgo is less. I'm paying less for the protection. I'm paying less for the insurance. In your car terms, this will be like, I'll pay, my deductible is $5 because my protection kicks in after $5. But the maximum level of protection I can get is only $10. Means I don't expect my car to be totaled. Yeah, there will be some minor scratches and dents. I could have a fender bender, and I want a protection for that fender bender between 40 and 30. And if car gets totaled, in this case, I'm exposed if car gets totaled. But what's the probability? Again, options is all probability game, nothing more. So this is, again, one type of a protection strategy is instead of buying a put, I could buy a put spread in which if I expect market to fall down 10%, 20%, I'm still protected. I don't expect market to fall down 60%. So I don't have to pay for that protection. That's a put spread. Third one is collar. It means you collar your portfolio within a range. You put we put a collar around our pet. You put a collar around your portfolio. You sell a call, and buy a put. And this comes from, it's a variation of our first strategy where you buy a protected put. But to buy that put, you have to pay $2.04 as a premium. And I don't know if markets will go down or not. But that premium which I'm paying, I have to pay it right away. I've been a good driver all throughout my life. Never had even a single accident. But I have to pay the premium. How can I avoid paying that? In this case, you sell a call to sponsor the put. So this is how your portfolio P&L will look like. In this case, I bought a long put at 40, like we have seen in portfolio, the put protective strategy, naked put. But to buy this, I sponsored it by selling a call at 50. It means my losses beyond 40 are protected because I bought a put at 40. But my upside, because I sold a call at 50, upside is capped. I don't enjoy that unlimited gains. If the stock goes out to 60, I only make money all the way up to 50. Beyond that, I don't make any more money. Now, for me to enter into this trade could almost be at a no cost. In this particular case, it is 24 cents. Imagine buying a put at $2, and here for the caller, I am paying 24 cents. I will still enjoy some of the gains. It could go $5 up. I'll enjoy that. I will write those upside. It could go $5 down. I'm protected beyond that. So in this case, I have put a collar around my portfolio, 5% on either side. Right? It means if it goes higher, I enjoy the upside up to 5%. If it goes lower, my loss is limited up to, so not 5%, $5. My loss is limited up to $5. My gain is limited up to $5. And I could do this at almost zero cost. In this case, it is 24 cents. Right? This is called a collar. This is a low cost protection method. Cost 24 cents. Many times now in recent times, I've done collars. Those who are patrons, they get an email or alert from me saying, I'm putting a collar around this position. And there's a reason, because on those tickers, I've already enjoyed gains on my portfolio. And I'm okay if I don't get to ride, the next 20% upside. I'm like, I already enjoyed handsome gains. Now I want to protect those gains. I have these options. So I picked up collar because I'm happy with the amount of gains that I have had in that ticker. So even if I don't get, another 30% and I will get only up to 10% more, I'm happy with it. So in that case, probably I'll do a collar on those ones. Right. So those who have received, those emails or alerts now understand why I did collar. The cost of a put is sponsored by the short call that we sold. Let's go back to this one. The put that I bought was for $2.04. And this is an example, right? This is a old leg of, I'm looking at June 19th. So this is not real. This is just for example. A put I buy it for $2.04. It is being sponsored by a call that I sold. At $1.80, I sold that call. So the put is sponsored by the short call. Risk below the put strike is covered. But the cost that I have to pay is I capped my upside beyond the short call strike. Means I don't get to enjoy the gains beyond $50. $50 is my short call strike. Overall, a debit trade, but a lot more cheaper than protective put. I could do it in 1/10, 10% of what the cost it was for buying a put. In many cases, in reality, I have done these trades at zero cost. So what strategies were tested? Now we talked about three things: protective put spread, and collar. Now let's understand in this particular scenario or the study, what were tested. Buy long call and a short. I see a comment saying buying long call and a short put. That you're taking a, then this is not a protective put strategy. This is a bullish strategy. Sorry, Vijay, that's not a protection strategy. Your long call and short put, that means you are completely bullish. You are really, really bullish on the market. If that's the case, that's not a protection strategy. What we are talking about is to protect the portfolio in case the market falls, not how to gain a lot more if market goes higher. So both long call and the short put are bullish strategies. So those will benefit if market goes higher. So protective put is when you buy a put. In this study, they looked at 5% below, right? Put spread. They looked at you buy the put 5% lower, and then you sell a put at $80, which is 20%. Means your protection is up to 20% dip. If market goes below 20%, in March it went up to 30%, then you are still accountable for that additional 10% loss. Another put spread in which you have a 5%, you're protected up to 15%. So your protection starts after market has fallen 5%, and it stays all the way until market falls to 15%. Next one is protection up to 10% dip. Means you are buying an ATM put, means your protection starts immediately. Zero deductible. This is a zero deductible plan. Your protection starts immediately, but you are protected only up to 10%. And then the collar. And in this case, the ATM strike price, where the market currently is at 100. So that is why, it is easy. If you look at 100 and then 5% is 95. So collar means you are buying a put 5% below market. So you have full protection below 95. And you are selling a call 5% above market. Means your gain is maximum 5%. If market goes high 10%, you enjoy only 5% gain. The maximum losses would be, and these are all the low cost. Protective put is the simplest. It is simplest. Doesn't say it is the most optimal. It is the simplest way. Just go and buy a put. This involves a little more understanding, put spreads, and the collars. You need to understand a little more, and you have to do two-legged trades, right? But those are all low-cost strategies. So, and the portfolios on which these strategies were tested. So these are the different strategies that were tested: buying a put spread at a different strike prices, and the collar. The portfolios on which it was tested is like 1 month portfolio, which is generally, I think 1 month or 1 to 3 months is generally what I see a lot more retail investors doing. Is I bought a put 3 months out or for the next expiration month. And then when that month comes in, I buy a put again. I buy a put again. So I buy a put 12 times a year because I want my portfolio to be protected. But if I don't buy a put, then my portfolio is exposed naked. There are some other strategies also tested in this study. Those are a little more complex strategy in terms of fractional, means some fraction of your portfolio is in this and some fraction is that. I'm not going through those. In the end, those were really kind of immaterial. So I want to go through the ones which you and we can use it in our real life. They also tested these strategies on 3-month portfolio. Instead of buying put options every month, let's buy 3 months. Let's buy 6 months out, and let's buy 12 months out. By now, if I buy an option 1 month out, if I have to pay $5, if I'm buying 3 months out, I may have to pay, $12, $15. You buy longer and longer dated options, it becomes more and more expensive. Right? So these are the various portfolios on which these strategies were tested. Okay, now let's look at the results. Let's look at what's the back testing period. List says selling, chance of assignment. Assume and selling of put, selling of call to sponsor the put. If that's the case, that's the best scenario. Market goes high, my portfolio has gone high, I'm okay to sell. Or if you're not okay to sell, we have talked about what to do. This is kind of a covered call and how to manage the covered call. But essentially, my fear that the portfolio or the market will go down, that didn't happen. So it's a good thing if it goes high. MR says, are we buying the SPY or using the strategies with each individual stock we own? MR, a completely different question. We talked about it in risk management. Generally, the way I want to do it is maybe sometimes I do collar on individuals, but then I also do an overall portfolio protection in which I know what's my portfolio delta, and then I need to manage through that delta. So both of them. All right, the back testing that was done is from 2002 to 2018. That's when this report was published. So it does not have the 2020 March crash, but it does have 2009 March. I don't know, was it in March? I don't know. It does have the 2000, the great financial recession crash in it. So one crash is included in it. There were 2 crises, 2007 and March 2009. From 2007 to March 2009, that financial crisis is included in it. It means, let's see how those portfolio protection strategies have worked out in this long term. And then later on, I will also do a quick review of another study from another group, which also covers 2020 March. Something to do with March. Financial crises are all in March. So let's look at 1 month rolling protection. This is SPY 500 put. This is S&P 500 from 2002 till 2018. We started with $100. Portfolio value is $100. That's where we started. And now in this case, I am buying a put every month. Month after month, I go out the next expiration period and buy a put. Or I buy a put spread. Buy a put at 90, sell a put at 80. I buy a put spread 95.85. Buy a put spread 190. Or I do a collar 95.105. And then I talked about fractional, etc., which I'm not going to get into the details. But these are the various portfolio protection strategies. These 4, 5, which is what we're going to focus on. So protective put is right here. So from 2002, if you have started buying puts month after month, because you need to have a protection for a portfolio, your SPY is here. If you had bought that put, your portfolio would have been here. Other strategies, put spread, were better. The other ones, put spreads, performed better than your puts. Let's look at a 3-month rolling period. Again, the protective put is the worst of all. In this case, I'm not buying every month. I'm buying a put 3 months out. And when I reach the 3 month, I buy a put again 3 months out. Or I buy a put spread again 3 months out. Or do a collar 3 months out. And the worst is the protective put. And this would be a surprise to those, who've been asked or have heard saying, oh, if you want to protect portfolio, buy put. This would be an eye opener for those people. The other strategies, put spread, etc., did better. And of course, you would say, why did I even add that protection? If I had not done anything, SPY would have been all the way up here, which is okay. I mean, you never knew that it's going to be a biggest bull run. So, but if you were to buy a protection, out of these protection, protective put was still the worst. 6 months. In 6 months, I think the protective put was the 4th worst on 6 months. Again, really didn't work out. 12 months, it is a little better. Again, just the 3rd worst in 12 months. There are a lot more detail in the doc which I shared. So in the end, the conclusion that came out from that is the protective put is the worst strategy of all. I'll say it once again so that it sinks in. Protective put is the worst strategy of all. And this is not the only study in which it has been found. There are other studies also which I've gone through wherein when they run through all the numbers, the protective put comes out to be the worst. It is better to just sell your portfolio than to buy put month after month for protection. Buying put rolling 1 month is too costly. So over a long term, your portfolio will bleeds a lot. Let me just bring up Think or Swim and see where the protection, let's look at what the puts are selling for. Let's look at SPY, S&P. Let's look at 1 month out. Let's go 1 month out. There we go. We found exactly 1 month out. Add the money put. Okay, we'll discount it for the fact that right now volatility is higher than usual times because this is election time. But just look at the numbers. Right now, $327 put is selling at $12.43, which is what percentage? Any engineers in here? That makes it what percentage? 12, hold on. $12 on 327. Here we go. $12 divided by 327 is almost 4%, 3.66. So I'm paying 3.66% for protecting my portfolio right now at the current price for 1 month. Let's say we discount it for the elevated volatility which we have right now, because generally the volatility stays between 15 to 20, 22. So let's discount it and saying it will be half, right? In past few months that's not a case, but let's say just half. And say we are paying, instead of paying $12, we'll $12.40, we'll pay $7 or $6. That still means I'm paying 2% premium to protect SPY for 1 month. I do this for 12 months. That is 24%. SPY is at 100. I am paying $2 as a protection. And over a period of a year, I would have paid $24 to protect my $100 investment in SPY. How much SPY returns in a year? Over a long period of time. Over, let's say, 20 years, 10, 15 years. The general return on investment over a long period of time on markets, stock markets, is what, 8 to 10%? If I'm not wrong. Why would I pay 24% to protect an asset which over a long period returns only 10%? I mean, that completely baffles me. Why would I ever do that? I would rather get rid of that stuff. I'll throw it out of my house. If it costs, it's like an elephant that I got as a pet. And I need to feed that elephant, and I'm losing tons of money on that elephant, which now I got to feed. Why would I have a portfolio in which I have to pay 24% as a protection, and that portfolio grows only 10% over a period of time? And here we are talking about longer period of time. I'm not talking about this year or next 2 years. Right? It could grow 15%, 20%, could go down 20%, who knows? But over a long period of time, the broad stock market, which is what SPY is representative of, is expected to grow 8 to 10%. Doesn't make sense for me to buy the put. Mathematically, it just doesn't make sense. Emotionally, people buy into it because it's easiest stuff to do. And if you're trading in options, take a note, easy is not optimal. Okay. So hopefully this latest numbers does open your eyes to how expensive that put is. So buying a put at 1 month is too costly, and over term, long term, it does loses. Only time when it wins is when I just buy it before the crisis. Gosh, I should have bought that put on end of February. Then I wouldn't be sitting here and talking about these things in a put. I'm like, it worked wonderfully for me. I knew what's going to happen in March. I bought my puts on February, and that's it. I didn't buy it in December 2019. I didn't buy it in January 2019. I bought it in February 2nd week, 2020. If I could do that, that's the time when the protective put would have worked wonderfully for me. And that's the only time when it will work, is when you just bought before the crisis. But can you time it? Unfortunately, I can't. And if you can time it, just let me know. I want to give you a call after the session. I want to learn from you. We'll switch roles. You talk about it, I will listen on how to time the market. But in absence of the fact that no one can time the market, forget about me. Only option available to me, or only choice for me, is to have an insurance always. It's like saying, I don't want to buy insurance right now for my car. I only want to buy it when I know that I'm going to get into an accident. can you time that accident? No. And that's the reason why government mandates us to have an insurance on our car always. And that's the reason why we need to have an insurance or protection on our portfolio always, because we can't time the market. But if you need to have it always, we just saw in today's rate, even after discounting for elevated volatility, still I have to pay 24% to protect my SPY investment. Really, really very expensive. I don't know why anyone in its right mind would just do protected put. Usually, the reason why people would do it, uncapped upside potential and full downside protection. And this is the selling point from the people who ask you to do put is you enjoy unlimited upside gains. But we saw that unlimited upside gains, right? Market was in bull run. How much gain did you enjoy if you were on protective puts? It didn't perform well. If you kept buying protection month after month, you really did not, your portfolio really did not enjoy those unlimited gains. You were much better off using other portfolio protection strategies. Right? So there goes the whole theory behind enjoy unlimited gains. Our finding shows, this is not my finding, the finding from that study, the authors, right? Our findings show that the risk-adjusted performance and drawdown characteristics of the protected put are only attractive during the tail risk events. Only when the market has fallen down for that period of time, your protected put will come to your rescue. But you don't know when that's going to happen. Compared to divesting means you sell your portfolio. If you are so scared that I don't want to invest in, stock, I'm scared that the market will go down, in cash, sit out. That's divesting. Compared to sitting out and other option-based protection strategies, it is less attractive during the modest drawdowns. Means market goes 5%, 10%, not the tail risk where the market goes like 30%. It only provides protection when you have those 30%, 40% draws. Modest drawdowns, 5%, 10%, it just didn't work. And never when the excess return is positive, which is what's been happening for last many years, right? Due to high cost burden from excessive premiums. Okay. So that's their conclusion that protective put doesn't work. Let's look at what they had to say about put spread. Meanwhile, questions. Ramesh said, this is good only if you own 100 or more stocks, won't help otherwise. Or should you buy puts for say 60 shares? So Ramesh, at the end of a day, you put all your shares in a big cauldron, mix it up, you know what your SPY beta weighted delta is. If my SPY beta weighted delta is 400, that's all my portfolio is. I may not have even a single SPY shares. So that's the concept we talk about when you're trying to look at your whole risk management, right? So, but if you have only 60 shares, in that case, you buy a put at a 60 delta, right? Not at 100 delta. So you manage your put buying based on how much of a delta overall portfolio beta weighted delta is. That's how you gotta do it. Put spread, not ideal, but it does work. It provides better protection against modest drawdowns because you are not paying too much to get into it. The difference here is in the put, I am paying a premium assuming that my car will be totaled. Never happened in my 25 years of driving. put spread, you're paying a premium. The cost you're paying premium is, I'll have a modest drawdown. I'll have a fender bender. I'll have a scratch here and there. I might have a minor accident. Motor might go out, things like that. It provides much better protection during the modest drawdowns. Poor tail protection, if it becomes total, my car gets totaled, then I should have just, if you would have divested, means I just gave up my portfolio, that would have worked better. Right? But how many times does that happen? So only exception was 100 to 90 strategies, that buy and sell 1 month option. It worked only during crisis. Otherwise, this was also very expensive. But can you time the market and buy this put spread 190? I can't. So I don't. So overall, it's not suited for portfolio protection. Let's look at the third one, collar. If want to use options, it is better to employ a collar with maturities 3 to 6 months. This is at least what their study found out. Equities generally have a positive drift. So employing longer duration will reduce the returns because the options will be ITM, means it will become in the money. So if you go out, let's say 6 months or 12 months, 12 months out, 9 months out, the stock eventually may cross your short call, because over a long period of time, equities have positive drift. So employ, smaller durations. I generally do 45 days, 30 days. If I have to do collar, I'm not done it 3 to 6 months, but that's just me. I'm sharing what the study has found. It is suitable protection strategy for investors who are more concerned with the downside risk than gaining more upside potential. What are you more concerned with? Based on that, you use collar. For example, I have used collars on stocks in which I've already enjoyed handsome gains. So I'm not worried about losing out on more gains. I'm now worried about protecting my downside. In those cases, I have done collar. That's a suitable protection strategy. If you are, you won't be sad if you lose out on getting more. Let me put it that way. What pinches you more? The loss of opportunity or the loss of portfolio? If the loss of portfolio value hurts you more, use this. In this case, you will enjoy the gains up to a certain limit, not beyond that. It provides a superior protection against both the tail risk events and the modest drawdowns, because we have bought a naked put here. So if a market falls down like it did in March, if the bottom falls from the market, this will provide superior protection. All right, any other questions till now? Otherwise, this concludes the study, which, this was a summary of this whole 100 pages, 100 plus pages of the study that I have shared. Net, just buying a protective put over and over, worst thing. Don't do it. Buying a put spread works okay, or during modest drawdowns. Stock goes 5% down, market goes 10% down, that'll work great. Market goes 30% down, 40% down, no, you are still exposed. Collar works best in the scenarios, but then you have to be comfortable with the fact that you're not going to gain more than 5% if market jumps up 5% in next 2 months, 3 months. If you are okay with the gains that you have had, and if you want to protect it, use collars. One last thing. Stop loss. I haven't talked about stop loss. And this is again one of the favorites of retail traders. I see a lot of talking heads talking about, I'm putting stop loss. Market goes high, I increase my stop loss. So let's look at another study on stop loss. Again, I want to cover everything around protection of portfolio. Stop loss is one way to protect your portfolio. Stop. If you're not aware, stop loss means you put an order which says if the stock has fallen to 90 from 100, sell my shares. Means your losses are stopped at 90 because you don't have any portfolio to protect after that. Your shares are gone. But does this really stop losses? And I've seen multiple studies. I'm going to share one of them with you. Is all right from Tasty Trade. Again, one of the think tank that I admire a lot and learn a lot from them is they did a study on stop loss. Stop loss in strangles. Okay. So this is what they found out. So let me increase it. Okay. I think I increased this too much. This is fine. Stop losses in strangle. So what, and again, we talked about managing early and managing at a profit target. We discussed all that in our previous sessions in Options Bootcamp. So this is where, the data from when you let the options go all the way to expiration, or if you manage early. Now what they have done is a back testing from having a strangle, means you sell a strangle, then either you let the strangle go all the way to expiration, or you manage it at 25 days to expiration, manage early. And what they found out on a 16 delta strangle, this is how the statistics were. From a success rate, not much of a difference, but because you manage early, you could have reduced your losses, cut in half. Other is to use stop losses, which is meant to reduce risk in stock trading, which I see a lot of people peddling is add your stop losses. Don't live without stop losses. Don't have your portfolio without stop losses. So why not incorporate them into our option trading? So they did a study from 2005 to 2018, 16 delta strangle, holding those strangle to expiration, managing early at 25 days to expiration, managing losers by putting stop losses, means managing losers at 25%, 50%, and 75% of the original credit collected. Right? If I sold a strangle and I got $1 as a credit, I will close my trade if my loss is 25 cents. Means the strangle I sold at $1 is now valued at $1.25, in which if I have to buy back, I incur a loss of 25%. Or I'll close and get out of that strangle when the strangle value becomes $1.50 or $1.75. Right? Perfect example of stop loss. When you do a stop loss, this is how your portfolio performs. Your win rate is way low. Your P&L is worse than letting it run to expiration or managing it earlier. Managing it earlier is always superior. Putting a stop loss came out worst. Right? How about a portfolio performance? If we started with $1 million initial portfolio and we put 25% into each of those strategies, manage early, 25 days to expiration, let it go all the way to expiration, don't manage at all, or put a stop losses that if you're making loss at 25, 50, and 75% of initial premium, get out. Let's look at how that performance has worked. 21 days to expiration, best. All the way to expiration, 50% loser was the worst. So that is why I focus on managing early. You know, if you are on the Slack channel, you'll see, I'll tell you, it's a time to start managing our portfolio because it is getting closer to 3 weeks to expiration. I don't have to put in stop losses. I don't use that. The diminished portfolio volatility doesn't appear worth the reduction in returns if you're using the stop losses. So stop losses doesn't work. There are better ways to manage your options portfolio. So that's about stop losses. So takeaways: buying put for protection doesn't work, again, over a long period of time. If you are thinking to buy puts today, considering that market will fall by end of next week, because whoever came into White House, that could work superbly. If you know that market is going to fall next week, go and buy loads of puts. But after that, who knows how market will behave. So you can't buy put as your protection for your portfolio over a long term. Just doesn't work. Like I said, if you can time that market, give me a call or just ping me, I'll call you. Better to do is collar, which is inexpensive. I already talked about it, that once a ticker hits my target, especially I want to do it now in this election season, I don't know where the market is going to go tomorrow. But if I've already got, let's say, 40% gains this year on a particular ticker, I don't have to be too greedy to leave that ticker exposed to the vagaries of what might happen in next week. I'm like, okay, let me go high 10%, sell a call, and then buy a put, do a collar. But that's because my portfolio has hit the target, or that ticker has hit the target. I've already got my cake. It's only, next icing which is to be claimed, and I'm okay to give that icing. So if you haven't hit your portfolio target, maybe you do a put spread. Again, depends on how much upside you want to gain and how much downside protection you want. Based on that, decide for yourself. Lastly, I want to say is just don't buy a put blindly. Make an informed decision. Understand what you're getting into before you buy a put or put spread. Okay. Yeah, there are other protection strategies called ratio spreads, back ratio spreads. I do some of those as well, but those are outside the scope of today's discussion. All right, so this concludes our comparison of portfolio protection strategies using options. Any more questions, do let me know. Otherwise, we are done. Right, so let me go through trades. That will be quicker. Trades. Yeah, as you would have seen from last week onwards, I moved it into a spreadsheet, much easier for me to manage it rather than copying and pasting content into Word doc, saving some time. All right, so let's look at the trades that I closed this week. And these are the trades which I have shared in this meeting. This is not the only trade that I've done. I've closed a lot more. And some of you already get those information. But let's look at what are the trades that I've shared earlier and have closed this week. Silver. Those who have been attending these sessions from July onwards know what's been the situation in silver. This was a horrible, I would say, one of the trades I would like to forget. I've been trying to manage silver for a long time because we did a silver trade here, right? Silver had been working as wonderfully for us, and I was doing straddles, and then boom, it made the moves haven't seen in last 3 decades. And then my short calls were all challenging me, right? But then we used our option trade management stuff, all the techniques that we've been talking about, and slowly reducing the losses on some of the trades. In this case, I was able to close the inverted triangle that we had at a profit. So last week, I had closed this $20 short call and $22 short put. Now my put is higher than a call. That is why it is an inverted triangle. We had gone inverted as a part of our option trade management. Overall premium that I had in this inverted trade was more than $4. It was around $4.21, right? I've been managing this trade since July. It was July somewhere here wherein I put in, this trade. A $20 straddle I put in on this date, 22nd of July is when I added that trade. Little did I know that silver will have such a big move. That's fine. We have to take what market gives. I could complain about market making move, or I could do a trade management, and that's what we've been doing for over 3 months now. And eventually we got an opportunity to close the trade on 28th. I closed this whole triangle on 28th because silver, after making all these moves, came down to 21.7577. Right, I closed this when silver came down to $21.77. Eventually exited this trade for $376 profit. Not, if you take into account all the adjustments that we have done on this $20 triangle, we kept rolling it, doing adjustments. Eventually I closed it with $376 profit. I'm pretty happy about it that I was able to close it at a profit. This was one of a pain that I had to go through it in trying to manage it. But that's okay. There is no gain without pain, right? So either I could have just closed at a loss and could have blamed some people in the market, or we had to persist through, persevere, manage your trade, time and again. Things will come. Market doesn't move in one direction always, and I got an opportunity out of this silver trade. I still have silver left in the portfolio. So let's look at SLV. I ain't done yet. I still have 24 put, which I rolled it out from October to November, and still have silver long 300 units. So which will continue to manage it. Now I'm intending to, maybe I'll watch silver for some time or start selling calls against it. Okay, that would be my action plan on silver. But for now, this trade that has been challenging us, I'm happy to get out at profit. That was the trade I closed. Let's look at the new trades. The trades that are still open that we've been talking about in these sessions for weeks is a pager duty, $30 call, which is a covered call. We opened on 922. It is still open. I haven't done anything with that. So I still have that. Let's look at pager duty. Oops. This is our $30 covered call. I own 500 shares of pager duty. I did a covered call on two contracts of covered call. Means if it goes beyond 30, shares will be called away from me, and it is okay for it to be called away. Then we also did on 21st, I also put a collar around the remaining shares. Means we just talked about collar today. I put a collar 25. I bought a put at 25. It sold a call at 35. Means if a stock falls below, my 300 shares are protected. And again, I I was okay to, protect 300 shares from catastrophic losses. And instead of putting all 500, I'm like, let's do a collar on the portion of shares, because the other 200 shares, I have a short call, which will benefit if market goes lower. So I did a mix of both short call as well as collar. And this, what I'm showing right now, is an example of a collar, which we talked about in portfolio protection strategy. So let me see, this is how it will look like. Right? If a market goes lower, I can't do just only 300. So this trade will start gaining if it falls beyond 25. So my 300 shares are protected by this trade. If it goes above 35, I will lose on the collar trade, but I have a 300 shares which will get called away. And I'm okay. I bought those shares at 24. I think my current cost basis of those shares, because I kept selling premium, is my current cost basis is $20. So letting it go at 35, where my cost basis is $20.66, I think is a pretty good return. I am happy that if it goes to 35 and get called away, because my cost basis is 21, even if it goes to 25 and below, I'm still protected with the gains in this one. So that's why I did a collar on this. Okay, let's, so that was on PagerDuty. EB, which is Eventbrite. My reopening stock isn't doing good because we are not reopening the economy. Can't do much about it. I have a strangle in it, white strangle. I'm still holding it little above my a break even. So I'll wait and watch. If it falls below, I'm okay to for this to be a sign. This will be my long-term play. And that is why I'm not did any collar on this one. Is it's okay. I have what, $5,000 investment in it only, so which is fine. I expect this to perform well when the market reopens. So that's around Eventbrite. Or XLU. XLU, we had an iron fly. We added that iron fly on, hold on, it may be a little eye testing, so let me increase. All right, XLU, we had an iron butterfly centered at 63. We opened it on 10.9. And last week I had mentioned, I think the stock was around 64. And I had mentioned that if it goes around 65, I will ladder on another trade. This is what exactly I did. Stock actually went out to 65.40. And I added another trade. So my original trade was this, 63, 68. This was the original trade. Now imagine stock was around 65 here. Means it started to challenge my original trade. So what I did was to add another trade, which is what I call my laddering of trades. And that's why I don't allocate all the capital in the first trade. I added this trade so that it recenters. So when I added the trade, the stock was right here. It means I got a lot more flexibility or buffer for stock to move in either direction. Last week, stock just moved down. It's okay, still way above our break even on the put side. But now the $63 seems to getting closer to our profit target. I will probably close that one. So this is where I added a new trade, which I want to share is our ladder trade. As I mentioned during the weekend session, I will be laddering a position. So stock was at $65.20. I laddered another one. Now with these two trades, the amount of capital that I wanted to allocate is done. I don't want to allocate any more capital to XLU now. So If stock moves against us, say if it continues to go down, we will start deploying option management steps. I could have done on when the stock went against me in my first trade itself, but the reason I didn't do it, because it was well planned. I had mentioned saying, this is my first trade on XLU. As a starter trade, I'm leaving room to ladder on more. So I laddered on more. And now my plan is I am done adding the capital that I wanted to allocate to XLU. Now I will move on to management of the trade. 63, probably I will close it on Monday, because it looks like that trade is profitable. That remains only 65 to be managed, and we'll manage it. It is a defined risk trade. I have no concerns in getting it through the election volatility, because my risk is capped. The maximum loss is defined, so it's okay. Which are the other open trades? Lulu and Square. Silver we already looked at. So let's look at Square. Square fell down 10%. I know someone asked, are you buying it? In the chat, someone asked, I'm not buying it because I already have this bullish trade. So if Square comes back up, it will be profitable. If it doesn't, our max loss is capped here, it'll be fine. I'll pick up some more trades. I will buy some more Square if it continues to go low, to accumulate a little bit of Square. But it's a defined risk trade, so I'm not much worried about it. Lulu, same thing. It's a defined risk trade. It is just outside the break even, but we got a lot more time in this trade. These all are 20th November expiration trade. I think Lulu has gotten earnings after the trade. After expiration. So if it continues to go below, I might start to do some trade management on this one, which means either I'll sell a call spread or maybe a call on Lulu. That depends on how market behaves in the next week. But in any case, it's a defined risk position. I don't have to worry too much about it, because the risk in this, the maximum risk is not something that my portfolio can't bear. All right, these are all the trades that we've been talking through. I also talked about the new trade that I did and wanted to bring to this team. Overall, it's been a good week. October again turning out to be a good month for me. Now we'll have to see how November's do. November, we got an election and all that stuff. I don't know, but I'm glad that still October we're closing down positively. Cool. So that's it for today. We are 20 minutes over time, so let's skip the earning stuff.
Please note that all the information presented is purely for educational purposes and is not a financial or investment advice. I don't know you, you don't know me, so do yourself a favor and don't invest or trade solely based on what you hear.